Assalamu alaikum. This is lecture number 19 of the Cost and Management Accounting. We are discussing the topic of budgets. And in the last lecture, we have looked at the details of an example and information that was provided in order to formulate a set of budgeted figures. The information related to the company called Enterprise Company. And you may find that as we go along in this lecture, the information that is used relates to the information contained in the last lecture. So it will be useful to refer each time there is some uncertainty about the information being used to the information contained in the last section, in the last lecture. The information regarding the organization called Enterprise provided details of products and costs and an opening balance sheet and other related data for formulating a budget, and we were asked to produce several different types of budgets. We said in the last session that budgeting is based and anchored on the sales budget. The first thing that therefore needs to be arrived at and formulated for the budget for the next period is the sales budget. All the other activities and budgets are going to be based around the sales budget. That's how important, therefore, the sales budget becomes. The organization is going to plan all its activities, the resources, what resources need to be made available, what assets are available, what assets need to be made available. All that is going to be based on the projected sales figure. Hence, the sales budget is going to be the key and probably the most important budget aspect of this budgeting. We will start, therefore, by looking at the sales budget, and we will use the information that was there in the previous session to formulate the sales budget for the enterprise company. Sales budget, normally it should be arrived at in as detailed a manner as possible. A lot of companies will use market research, market data in order to formulate the sales budget. If it is an ongoing company, then you have the result of the previous year in front of you. So that can be one basis and one source of information to base your future forecast on. Of course, it won't be the only basis, and you will need to add any additional activity and any additional products that the organization intends to launch, any new products, any areas where it feels it can expand and increase the sales and the sales demand. Therefore, the sales budget is going to be formulated by taking all these different aspects into account. The sales budget. The sales budget shows the quantities of each product that the company plans to sell and the intended selling price. It provides the prediction of total revenue from which cash receipts from customers will be estimated. It also provides the basic data for constructing budgets for production, selling and distribution, and administrative expenses. The sales budget is therefore the foundation for all other budgets. If sales budget is not accurate, other budgets will be unreliable. Hence, the sales budget is going to set out what products the organization or the company intends to sell in the next period and what quantities. And it should be in as much detail as possible. Of course, starting with the monthly budgets that you have per month, the items that you need to sell for each product. And then it can be divided again by territory, that what amounts are going to be sold in what territory, depending upon how widely the company is distributing its products, and depending how large is the sales force, and depending how large is the sale itself. Various territories are going to be defined by the organization, and they are going to allocate different targets for different territories, and therefore there will be a budget for each territory and for each month. So we are saying that sales is going to be an important budget. It will probably be based on some kind of market research and other information available, such as the previous record and past history of the organization, and any additional new plans, future plans. So sales is going to form the basis, and we have said that all the other budgets are going to be based on that. The budget for production, the budget for purchases, and things like that. Financing will also be related, we have said, to our budget of sales. So in this case, the sales budget is as follows. Assume market analysis show this result. For product alpha and beta, if you remember, two products, alpha and beta, units sold are expected to be 8,500 and 1,600. The price for alpha is expected to be 400, and for beta, it is expected to be 560. This will give the organization a revenue from alpha of 3.4 million and from beta of 896,000, and the total revenue expected by the firm is 4,296,000. This will be supported by detailed budgets showing territories, monthly details by product, and we have set an example of breaking down the territories here is north, south, east, and west, and for alpha and for beta there is a projection, and the projection is as follows, that in north, alpha is expected to sell 3,000, in south 2.5, east 1,000, and west 2,000. Beta will sell in north 500 units, south 600 units, east 200 units, and west 300 units. This is providing us the detail of the market analysis, and it is showing us what quantities the company expects to sell. It has the two products, alpha and beta, and it has different territories. For simplicity, in our example, we have assumed the four territories, north, south, east, and west, and we are shown the quantities of each product in each territory. We also know the selling price, the expected selling price, and therefore we have an estimate of the overall sales revenue for the budget period for this organization. This overall total revenue and this total sale is going to present and form the basis of the other budgets. Now, we have so far divided our sales into four territories. There could be more, and there could be local as well as international territories, and that will depend upon the size and operations of the firm. We will look at now one additional analysis that could break this sales figure further. Detailed monthly budget for four territories. There could be various forms, and one form used here is that across horizontally you have the four territories of north, south, east, and west, and a column at the end for the total. And each territory will show and have a column for units and have a separate column for value. So north has units and value, south has units and value, and so forth for the other territories as well as the total. Then on the left hand side we have the column of the month, and therefore for each month you can show, starting with January, what would be the alpha sales and the beta sales, and therefore the total January sales. And these can be divided into the four territories as laid out. The units as well as the value. Units multiplied, of course, by price will give the value. And so for all the other months, February, March, April, May, and so on, right up to December. And you will have then at the bottom a total figure for the sales of both alpha and beta. Alpha sales for the year in one territory, as we said in the earlier slide, would be 3,000, and beta sales would be for the year in the North Territory of 500. Here, the prices that have been used are the same as used in the previous session. We were using a selling price of 400 for alpha and 560 for beta. This would give for the territory North for the entire year from 3,000 units of alpha a revenue of 1.2 million. And similarly, for beta, the 500 units, we would get a value of 280,000. So the bottom line is showing all the units of alpha that are expected to be sold in each of the territories, as well as in the end the total. And they are being shown together with the value of those units, which is the sales revenue using the sales price just said. So in this way, the sales figure can be broken down. In our example, we have broken it down into months and then by territory. And we have used two products, alpha and beta. An organization might have a large number of products, and therefore, for all the products, it will have a separate budget and a separate forecast of the units as well as the price giving the revenue. And there are different ways in which it can be then planned on spreadsheets and showed. We have shown the months on one side, and we have shown for each month all the various sales across in the territories. If the number of products is very large, you may have, and it might be more suitable to have the products on the horizontal side and the months on the vertical side, and so forth. There could be different presentations. The idea will be to show for each product and for each month and for each territory the sale that is planned and forecast. So it can go into a large detail, and it can be a widespread long working which must be detailed, and it must be prepared. And the more detail and the more thought and planning that goes into sales budget, we said, the better it is, because the sales budget needs to be as accurate as possible. At the end of the day, it is, after all, a forecast. It may or may not happen, but it has to be a best forecast and the forecast on which we are going to base the allocation of our resources. The other activities of the firm are going to be based on this forecast. Different types of sales forecasting activities are used, and the market, of course, is probably the best source to provide, and those people who are closest to the market should be referred to, and they should be involved in the planning and forecasting of sales. Annual production budget. We have two departments, Department 1 producing alphas and Department 2 producing betas. Units to be sold, and this is information that we can see from our sales budget, was 8,500 for alphas and 1,600 for betas. The planned closing stock is information contained in the question. This is 1870 for alpha and 90 units for beta. Hence, the total units required are 10,370 and 1,690 respectively for each alpha and beta. This is the number of units that should be made available, and deduct from that the planned opening stock of 170 alpha and 85 beta to give you the units produced of 10,200 alphas and 1,605 betas. Department 1 and Department 2 total production. The total production for each department should also be analyzed on a monthly basis. So looking at the production budget. The production budget will use as its base the quantities that are expected to be sold. Those quantities that are expected to be sold then will be adjusted for the inventory levels. Whatever inventories we have, which we desire at the end of the period, this will be a planning process for the organization to assess how much inventory level should exist at the end of the year in order to cover any shortages and any expected future deliveries. So we need to make available the quantities that need to be sold plus the inventory that should be held. That is the total amount of product that should be available. From that, we are going to deduct the opening balance of inventories because they already exist. So we don't need to produce what we already have as opening balance of inventories at the start of the period. So expected sales plus the closing inventory less the opening inventory. This is going to provide the quantities of production. We have in our example used 2 products and 2 departments and each being produced in 1 department. This is a simplified scenario. In practice, the organizations are going to have many products and they're going to have several different departments. So the production plan will be based in a similar way on the forecast sales of each product and the inventory levels. And it can therefore be spread out and it can be detailed which product is going to be produced in what quantity and what would be the required period and time within which it will be produced. Taking into account the inventory levels, we arrive at the quantities, and once we have the quantities of the production, then that production quantity needs to be further analyzed by month. And detailed schedules and workings can be done, and we can have information laid out before us what would be the production for each product each month. And we are using the month as a breakdown as a suitable period. It might be more relevant for organizations to use different periods, either shorter, fortnightly, for example, or weekly production schedules, or longer bi-monthly or quarterly production schedules, showing what would be the detail of production required per month or per week and so on. Hence, having looked at the sales budget, we can now formulate our production budget. Next, we can look at the direct materials usage budget. The supervisors of departments 1 and 2 will prepare estimates for the materials required to meet the production budget. Department 1 and Department 2, we have said in our case 2 materials are required, material X and material Y. So seeing what is the quantity required per unit of product and what is the number of units required to be produced, we can arrive at what would be the material that will be required. In our case, material X for Department 1 producing alphas, the units required are 102,000 and the price we were told is 7.2. This will give the cost of material X for Department 1 of 734,400. For Department 2, material X, we are going to require 12,840 units at a price of 720, giving a total cost of 92448. Again, for material Y, we will need 51,000 units. The price is ₹16. The total cost will be 816,000. In Department 2, we are going to need 14,445 units at a price of 16 to give a cost of 231,120 and gives a total material cost for Department 1 of 1.5 million and that for Department 2 of 3.2 million. In Department 1, the cost is 15 million, whereas Department 2 cost is 3.2 million. We have shown some workings, and we can see that material X, the quantity and the units that are required for production are 10,200. And 10 units of material X were required for 1 unit of alpha, and therefore 102,000 units of alpha are going to be used. In the 1,605 units of production, because there are 8 units of material X required for production of beta, we are going to need a total of 12,840 units of material X for producing betas. Similarly, material Y, 10,200 units, 5 units per unit of alpha, 5 units of material Y. This will mean we will need 51,000 units of material Y. And similarly, for betas, we are going to use 9 units per unit of beta, needing a total of 14,445 units of betas and material Y. So now we have seen the preparation of the materials usage budget. Materials usage budget, the information, of course, is contained within the question and details provided. But from a perspective of answering questions in the examination and being able to work out, this is a good exercise in being able to see how the material usage is calculated. First of all, we are being given what is the consumption per unit of product of each material. So once we know that each product is going to require so many units of material X and so many units of material Y, and we have 2 products using material X and Y, we can calculate the total amount of materials of X and Y that are going to be required. Given the quantities of the material that are required, we also have a forecast of prices. Using those prices, we can arrive at the cost of the materials that we are likely to use. So this will be the budget of material usage for the organization, using the cost forecast and the quantities that are required to be used. The layout is important to be able to clearly display exactly the information that is there. For example, each material of X and Y, how much of that is consumed within the products of alpha and beta, or in our case, the departments 1 and department 2. We have shown the working of each of these materials. The information has been taken from the illustration provided and the information of the quantities that are going to be used. In arriving at the budgeted usage, we have seen that we have used information from the production budget. So once we know what is the production budget, we use that production budget for estimating the materials usage. As we saw, the production budget was based on the sales forecast. So all these things are now being coordinated. The sales forecast providing a production budget, the inventory levels being forecast and adjusted for production, and now the production budget is used in the materials usage budget. So then the material usage can be planned and the cost can be allocated and planned how much expected cost is to be incurred. Again, along with the production budget, as we divide the production into monthly forecast, the budget for material usage can also be divided into a monthly forecast. And it should be matching and meeting the requirements of production. So the function of the purchasing function will be to provide adequate materials for production on a timely basis for it to meet its regular monthly production targets. All 3 functions have to be aligned. All 3 functions have to meet their targets in order for the final sales target to be met. Direct materials purchase budget. The objective is to purchase materials at the right time and at the planned purchase price. It is necessary to take into account the planned raw material stock levels. In our example, we have materials X and material Y. Quantity necessary for production for material X we have 114,840, and for material Y, we have 65,445. The material X is going to be the total of X used in both products A, alpha, and product beta. And from our previous budget, we could see 102,000 units were required in alpha and 12,840 were required in beta. So the total amount of material X that will be required will be 114,840. And similarly, for material Y, we had seen that 51,000 units would be required of material Y for alpha, and 14,445 units were going to be required of material Y for beta. This gives the total material Y usage of 65,445. The closing stock figure is a planned figure, and that's again using the information provided, 10,200 for material X and 1,700 for material Y. And this gives what needs to be made available of material X, 125,040 and 67,145 for material Y. We deduct from that our planned opening inventory, 8,500 units of X and 8,000 units of Y, to arrive at the total units purchased of 116,540 of X and 59,145 of Y. The planned unit purchase price we know is 7.2 for X and 16 for Y, and this gives the total purchase cost of 839,088 for X and 946,320 for Y. For detailed planning and control, it will be necessary to analyze the annual budget on a monthly basis. Direct materials purchase budget. And again, now we have seen that we can now combine the budget for material X and material Y and have an overall organizational budget for purchasing this material. The material X is going to be purchased for the entire organization, and it is going to incorporate all material required for Department 1 and for Department 2, i.e. alpha and beta. Whatever is the amount of production for the entire year required for alphas and for betas, the total amount of material X will come out as what needs to be purchased. And similarly for material Y. Now, therefore, the purchasing is going to be on the basis of materials. What materials will need to be purchased and in what quantities. The quantities will be determined by the usage budget, as we have done over here. The usage budget identifies what quantities are required for each material for meeting all the production requirements. In our case, these two materials, X and Y, both are needed in production of alpha as well as beta in both the products. Organizations with a range of products and different types of products requiring different materials might require, therefore, a certain number of materials for certain products and different materials for different products. So an overall purchase plan will be made for the entire materials required for all the products. We have said that it would help and it will be necessary to break this down at least into a monthly analysis. The production cycle that is being followed by the organization will also determine how frequently the purchases need to be made, and therefore how the budget needs to be analyzed into different periods. Purchasing is going to be important because it is going to determine the cost of the product. So therefore, the cost will need to be borne in mind, whatever has been planned. The idea of the budget is to provide an indication and therefore a target of the prices that need to be met. So the forecast price lays down the quantities and the price and the cost that needs to be incurred. Managers and buyers will get together and their target will be to buy at the right time, the right quantity, and the right price. All these three things put together will provide the organization with the necessary resources and materials required in their production. Again, we are seeing that there is a coordination within the budget of all the different functions, and all aspects are being put together. Purchasing is going to determine what is going to be produced, and production is going to determine what can be sold. Delays in purchasing perhaps will lead to delays in production. And so the coordination and the timing that needs to be regularly aligned. That's why we have said this planning is something that is a continuous process. You cannot plan at one point and say for the rest of the year the entire thing will work on its own. So every time there have to be adjustments for whatever differences that have occurred in terms of the materials required, the materials being purchased, in terms of the production, in terms of inventory levels. And inventory levels will be determined by the actual sales in the market. Market conditions change, inventory levels can change, and therefore production and buying must be adjusted accordingly. Factory overhead budget. Anticipated activity, 102,000 direct labor hours. Department 1, 10,200 multiplied by the 10 hours required per unit. 24,075 direct labor hours for Department 2, where 1,605 units were expected to be produced, and each unit requires 15 hours. So this gives an anticipated activity in terms of direct labor hours. We have used direct labor hours as the basis for allocating overheads. Coming down to the departments and the expenditure of overheads, variable overheads, the rate we were given for each department. Let's look at, first of all, controllable overheads. Indirect material, Department 1, the rate is 1.2, and Department 2, the rate is 0.8. So what would be the overheads for indirect materials for Department 1? We are going to take the activity of Department 1, the number of hours are 102,000, and multiply that by the rate of overhead for Department 1, which is 1.2. This is going to give us 122,400 as the overheads of Department 1. Similarly, if we want to know overheads for Department 2, we know the rate is 0.8, and in Department 2, the hours that are required are 24,075. So indirect material cost in Department 2 will be the hours of Department 2, 24,075, multiplied by its indirect material overhead rate of 0.5 to give 19,260 as the overhead cost of Department 2 for indirect material. Similarly, for indirect labor, the indirect labor, both departments, the rate is 1.2. So we just look at the hours, 102,000, 1.2 multiplied by that gives 122,400 again as the indirect labor cost for Department 1. And now for Department 2, the hours are 24,075 and the rate is 1.2. So 24,075 at the rate of 1.2 will give 28,890 as the indirect labor overhead cost for Department 2. And similarly, going on to power, the variable portion, we have discussed the variable portion of power. The rate was 0.6 for Department 1 and 0.4 for Department 2. Again, using the hours, the 102,000 in Department 1 hours multiplied by the 0.6 variable rate gives 61,200 as the power cost for Department 1, the variable portion. And again, using the rate of 0.4 on the number of hours of 24,075, this gives 9630 as the power overhead cost of Department 2. Maintenance is again the variable portion. We have highlighted the rate here of 0.2 and 0.4, and on a similar basis, using the number of hours, the overhead for maintenance is arrived at as 20,400 and 9,630. Non-controllable overheads are fixed amounts. Depreciation, we were told 100,000 and 80,000 for the two departments. Supervision cost the fixed portion of power cost, maintenance, and therefore giving us a total overhead of 612,000 for Department 1, 192,606 for Department 2. Using the basis of the number of hours, we can arrive at the hourly rate of overheads put together. Total overhead, hourly rate, the 612,000 divided by the 102,000 direct labor hours is going to give us a rate of 6 per hour for Department 1 and similarly 8 for Department 2. In Department 2, we are using the total overheads of 192,606 and dividing that by the number of hours anticipated, which is 24,075. This gives the Department 2 overhead rate of 8. The overheads is always an important aspect of budgeting, and it needs to be accurately allocated and identified. We have in our example used the anticipated activity. The rate that we have based our overhead working on is direct labor hours. So we estimated what would be the total overhead direct labor hours required for each of the departments. We were using 102,000 total hours for Department 1 and 24,075 for Department 2, arrived at by looking at the number of units to be produced and the hours required for each unit to be produced. Looking at the overheads, we looked at the overheads in two headings, the controllable and the non-controllable. The controllable is the variable side, where we have used indirect labor, indirect material, power, and maintenance. These are the controllable overheads, and we have used our rates of allocating the overheads to arrive at the estimated cost for each department based on the number of hours. The hourly rate was the basis of allocating to the departments what their overheads are going to be. So for indirect labor, for indirect material, for power, and for maintenance, we have used the hourly rate multiplied by the number of hours to arrive at the overhead cost. And similarly for the non-controllable things like depreciation and the fixed portion of power and fixed portion of maintenance and supervision, those are uncontrollable because they remain fixed. Depreciation will be an annual fixed charge. Again, the power and the maintenance, where they are fixed portions, they are likely to remain constant. So therefore, we have then taken the total overhead and we have taken the controllable, non-controllable, total overhead, and we have estimated for each department what would be the total amount of overhead to be incurred. Once we have the total overhead, we can then establish a rate for charging overheads as we go along. And the number of hours was the basis. We used direct labor hours as the basis to arrive at the rates. The rates used here were rupees 6 for Department 1 and rupees 8 for Department 2. This goes to show that Department 2 is therefore per hour consuming more overhead than Department 1. This is the basis of providing an overhead and having an overhead cost within the budget. So the budget is now, we have covered the budget for production, the material usage, and the purchase, and now we have looked at the budget for overheads. Selling and administration budget. In practice, separate budgets would be prepared for selling and for administration. For ease and for simplicity, we have combined the selling and administration budget. Normally, they would not be combined together. The selling, we have salaries of 74,000, commission 60,000, car expenses 22,000, and advertising 80,000. This gives selling budget of 236,000, and the admin side we have stationery of 4,000, salaries 28, and miscellaneous of 8,000, giving a total of 40,000 as the budgeted cost for administration, and the total selling and administration budget amounts to 276,000. In our example, we have combined the selling and administration budget together. In actual fact, as we have said, this is not something that you normally combine together. Selling should be kept separate and admin should be kept separate. Both of them we can see are budgets and quantities and amounts of nearly a fixed amount, comprising basically of salaries and comprising of commissions and things like that, car expenses. These are expected because the territories that are being used for our sale purposes, if they are going to remain the same, then they are going to probably remain the same from one year to the next. But they will be adjusted where new territories are to be added. If we are going to increase the concentration of our sales force within any territory, the numbers will increase, so that will be reflected in the budget of the salaries, the car expenses, the commissions, and things like that. So the budget of sales will be a matter of looking at the cost of providing the sales service and the sales force. Usually, this can also be divided by territories, what will be the cost for each territory, and it will also be split on a monthly basis. Administration is usually another normally fixed overhead. Administration usually does not change in direct proportion to the units being produced or sold. And so it can be regarded as a fixed overhead comprising mainly of salaries and stationery and office expenses of that nature. So in our budget, we are going to forecast this again on the basis of what we expect the number of people to be in the next period. Where we expect some administration personnel to increase, where we expect some expenses to increase, then those will be incorporated in the budget to provide an accurate administration and selling cost budget. The master budget. When all the budgets have been prepared, the budgeted profit and loss account and balance sheet provide the overall picture of the planned performance for the budget period. So once all the other detailed smaller budgets have been prepared, then what we are calling the master budget can be prepared. A master budget is going to incorporate all the other budgets and provide a single perspective for the organization, the complete picture as it were. And therefore, it is going to include the information from the sales budget, from the purchasing budget, the production budget, and from the cash budget, and so forth. Let's look at the detail of the master budget in our example. Budgeted profit and loss account for the year ending 2000X0. The sales budget is going to provide the information on sales revenue. In our case, this was for 296,000. The opening stock of raw materials, this will usually be the closing stock of raw materials in the previous balance sheet, in the previous year's account. We have set out in detail the purchasing budget, and that is showing 1785408. This figure of 1785408, this comprises the total purchase cost of material X of 839088 and of Y of 946320. So the total, if you refer back, you will find the detailed information on cost of each material, and that comes to 1785408. Again, the closing stock is going to be of raw materials, is going to be as we looked at our usage budget and the forecast of our inventory levels. This will give the cost of raw material consumed. The direct labor will come from the detailed direct labor budget, which will be the labor required in production of the required units. Factory overheads we have just looked at in detail, and the total factory overhead cost is 804606. This provides the total manufacturing cost. Add to that the opening stock of finished goods. This is inventory levels that have already been forecast and already exist in the previous balance sheet. And from that, we reduce closing stock of finished goods. This is going to involve some inventory valuation. We will look at in a moment the inventory valuation for the end of the year based on the end of the year forecast of quantities. Adjusting for these inventory levels, we come to the cost of sales of 3,624,566, and the gross profit is 671,434. Deduct from that the selling and admin expenses of 276, and we arrive at the 395,434 as the budgeted operating profit for the year. So the budgeted profit loss account for the year is now showing us the total sales and the cost of sales split up by the opening stock of raw materials, the purchases, the closing stock, and adjusted for the level of finished goods, opening level of finished goods and closing level of finished goods. Cost of sales deducted from sales will give us the gross profit, and in our case, the gross profit is 671,434. From that, we deduct the selling and admin expenses to arrive at the budgeted profit for the year. The inventory valuation we can just look at briefly. As we saw in our previous slide, we have used an inventory closing value. We have two products, alpha and beta. Now, inventory valuation is going to incorporate direct materials, direct labor, which is the direct cost, as well as the overheads. And the overheads allocated on a per unit basis. So we know that 1 unit of alpha requires 10 units of material X, and the price is 7.2 each. So the per unit cost of material X in alpha is 72. The per unit cost of material Y in alpha is 80, and the direct labor, which required 10 hours, is 120. So that is the direct cost. The overheads, we have the rate calculated as 6 per hour for alpha, and we know there are 10 labor hours required for alpha, so 60 will be the factory overheads allocated per unit of alpha. And similarly, for beta, we will have direct materials of 57.8, 144, and 180 as direct labor, and add to that, there are 15 hours required for each unit of beta, and we know that the rate of beta overhead was ₹8, so that gives 120 overheads to be charged to beta. This gives the unit cost of alpha of 332 and of beta of 501.6. So the closing stock has been valued as the units of 1870 ending inventory, and using the per unit rate calculated of 332, giving 620,840 as the closing stock value of alpha, and for 90 units of beta at the rate of 501.6, 45,144 as the value for beta, giving total inventory value of 665,984. This is a very good example for students to see the inventory valuation. Inventory has been valued, and normally in inventory values, we are going to include the material cost, the labor cost, as well as the overhead costs. This is also according to the International Accounting Standards for valuing inventory. All the related production overheads must be absorbed and allocated to inventory to which they relate. So therefore, a per unit cost is calculated for each item of inventory, and that per unit cost will include the material, labor, and overhead. We have seen in our basis, in our working, how that is done, and a unit cost for each product has been arrived at. And then looking at the number of units in the inventory, we can value the inventory by using that per unit cost. So hence arriving at a per unit value of inventory, and therefore an inventory valuation. In our cost and profit and loss account, we have used the total inventory at the closing values, and we have shown you how the closing values are calculated. That's all for this session. Thank you very much.